Most businesses loses profit not because of bad sales, they lose it because of hidden financial mistakes which they never track. Today in this video we will talk about 5 financial mistakes which cost businessmen their profits. Mistake number 1 is confusing revenue growth as profit growth. We have seen businesses where sales has increased multiple times, but unfortunately their profit has not, or even worse, we have seen their profits converting into losses. This is because as their sales has grown, their expenses has grown more than what their sales was contributing, resulting into increase in losses or reduction in profits. As a businessman, you need to understand sales and gross margins or net profits are two different numbers and are not directly related to one another. So you need to monitor these numbers separately. So mistake number 2 is not monitoring your gross margins product wise or service wise. Imagine you are in a business where you are dealing in multiple products or you are serving multiple clients. Now what your profit and loss account statement will show is your average gross margin, but averages do lie. It may so happen that one of your product line or one of your services are giving you high margin, whereas your other products or other service lines are not giving you that high margin or even making losses. If you are not monitoring your margins by individual products or services, you will not be able to identify these services which is making you losses or giving you lower returns. Now once you have started tracking this data of product wise margin, you will be able to take decisions like which product you need to promote more, which product you need to stop servicing, which clients are your better clients, and you may come up with a data like some products may be not having that great sales, but because they are having good margins. Mistake number 3 is not making budgets, and when you are making them, not reviewing them on regular basis. Now imagine a situation where you want to do a turnover of 25 crores in next year, and after the end of 6 months you realize that you have only made a sales of 3 CR. So this is where a proper budgeting and forecasting can help you. When a budgeting and forecasting is done at the beginning of the year, now you clearly know how many orders you need to make to achieve sales of 25 crores. What are the costs involved to achieve the sales of 25 crores? What will be the working capital requirement? What will be the HR requirement? And what will be the finance requirement? Now because you know all these details well before in hand, you will be in a position to plan them accordingly. And when you track this data on monthly basis, again you will be able to identify where are the deviation from the planning and you can take immediate action. Rather than you also need to review those budgets on regular basis to see that the budgets that you have made are realistic. And because of any market condition beyond your control, if the things have changed drastically, you need to revise your budget and track them accordingly. The 4th mistake that most business owners do is poor working capital discipline. Now working capital is majorly comprised of your receivables, your inventory and your payables. Now if these 3 numbers are not managed properly, you will be investing heavily in your business, but that investment will not be funding your business, it will be funding some other's business. Talking about inventory, it should be at an optimum level. Over inventory will cost you blocking of working capital, resulting into extra or added interest cost, and under inventory may result into loss of sales. So you need to analyze your data and identify what is an average optimum inventory which you should be maintaining, and you should be maintaining those levels. Also, analyzing the quality of inventory that you are maintaining will help you understand which inventory is moving faster and which is not, and accordingly you can plan your inventory more efficiently. Talking about receivables, you need to track them on regular basis, make a proper follow-up, and to see to it that what is receivable in this month has been collected in this month itself and it is not pushed to next month. If your receivables are not collected properly, your investment is funding not your business but your client's business. And lastly, your payables. You need to manage your payables in a manner that you are optimizing your working capital. If you are giving a credit of 3 months on your sales, you cannot pay advance to your vendors unless you are having good profit margin and you are getting the benefit of making the advance payments. You need to look out for vendors who gives you better credit period so that you are not investing heavily in your working capital. And what is due after 90 days, don't make a payment after 30 days because he called you many times. If a bill is payable at 90 days, see to it that you are paying only after 90 days and not before that. And the mistake number 5 is not linking your finance with strategy. Very often we have seen for business owners, finance is all about data entry, compliance and tax filings. In reality, finance is way more to business than this much. If finance is done right, it can help you in decision making. You can use your numbers and analyze them to help you in pricing decisions. You can use your financial data to take HR hiring decisions. You can use your financial data for expansion and growth strategy. And if you are not using your financial data and finance function for this kind of decisions, you are leaving money on the table. So, profit is not just about sales, it is about system. Share this with a businessman who wants to grow fast and wants to keep his profits healthy.